If you live in Britain, you'll have heard many times that housing is one of the best investments that you can make. If you had bought a house in 1980, its value would be nearly 10 times the initial price, a 1,000% rise in 43 years. Even in the last 14 years, house prices have risen 85%. No wonder people like to say you can't go wrong with bricks and mortar. But with house prices now falling, does it really deserve its reputation as a great investment? Firstly, the rise in nominal prices is only part of the story. We also need to take into account inflation. If you had bought a house at the start of 2007, then adjusted for inflation, the value of your house would actually have fallen 20%. And this is during a period of a so-called housing boom. Even in the past 18 months, real house prices have fallen 13% in real terms. And if we go back to 1980, the 1,000% rise in house prices does sound amazing, but adjusted for inflation, it becomes only a 95% rise. And that only works out at an average 2.4% increase in real prices, which, by the way, is pretty close to the average economic growth rate in the UK. However, of course, there is one big caveat to using real house prices, because when looking at housing as an investment, we have to compare it to the alternatives. Recently, we've had an unprecedented period of negative real interest rates, an inflation rate higher than the rate you can get on savings. If you had kept £175,000 cash in the bank in 2007 at an average interest rate of 1.5%, then today that would be worth £220,000. If you had put the same money into housing, it would be worth more than £262,000 plus any rental income on top of that. In a period of very high inflation, buying an asset like a house is actually a good way of protecting your savings against the worst of inflation. For example, housing was a great investment during the inflationary decade of the 1970s. But when looking at house price indexes, there's another consideration to take into account. In the past 40 years or so, Britain has spent billions on home improvements, extensions, an estimated £40 billion alone in the year 2022. When we look at house prices, we have to bear in mind we are not comparing the same housing stock. For example, I bought my house in 2005 for £185,000. Now it is valued at around £350,000. But I spent £45,000 on adding a front and back extension. And by the way, I got a very cheap builder. Other builders were quoting around £75,000 for similar work. And along my street, I would estimate around 70% of houses have added some form of extension in the past few decades, often an extra bedroom. So yes, prices have risen a lot, but the houses are also different. So it means that house price indexes are overvaluing the rise in prices because houses have more capacity than they did in the past. Also, if you're an investor, there's another thing to take into account, and that's capital gains tax. Landlords selling their property can pay up to 28% on the capital gains that they make. And from 2024, landlords will see a reduction in their capital gains threshold from £12,000 to £3,000, meaning they will be eligible for paying even more capital gains tax in the future. In recent decades, Hamptons shows that the biggest profit for landlords has come from capital gains. This has been one of the main advantages of investing in UK property. But this of course raises the big question, how long will prices fall or stagnate? When can an investor start to see rising prices? Now this week there was some marginal good news in the mortgage market, with Halifax knocking 0.7% off its 5-year fixed rate mortgage. And this is perhaps a reflection that the worst of rising inflation and interest rates are over. And it is good news. But on the other hand, even with this slight reduction in mortgage rates, the market is still adjusting to the new normal of interest rates of around 4 to 5%, rather than say 1 to 2% for the past 13 years. And with buyers able to get smaller mortgages, there will be downward pressure on demand for a couple of years at least. This analysis suggests the bank could face inflation above target into 2025, which will mean a prolonged period of higher interest rates. Now, despite real prices falling in recent years, the ratio of house price to income ratios has recently reached record levels. And if this sounds contradictory, it is a reflection of very low real wage growth in the UK. And as the housing market adjusts to the higher interest rates, the easy capital gains of the past 13 years seem very remote. So it makes investment less attractive at the moment. And it's not just about higher interest rates. The housing market will also be affected by deteriorating economic situation. The economy just avoiding recession, but a rise in mortgage arrears and a rise in bankruptcy does hint at future problems, especially with the effect of higher interest rates to be felt more next year. So given all these pressures on the housing market, it's a bad time to invest when price to income ratios are so high, especially if you're a buy to let investor. Capital economics analysis suggested that 21% of rented properties will be making a loss with mortgage rates at 6%, assuming a yield of around 4.7%. And already buy-to-let mortgages are seeing a sharp rise in arrears. Now, whilst there is evidence of the amateur buy-to-let investors selling due to all the short-term difficulties they're facing, what about the big professional investors who can buy properties with cash rather than take out a mortgage? Are they taking fright and selling up? Well, at the moment, not really. Despite recent falls in yields, housing does provide fairly reliable long-term returns, especially with the strong growth in rental demand and rental prices we've seen recently. Because at the moment, all the data points to further pressure on the rented market. The demand for private sector rented accommodation is rising significantly due to the rise in the population, immigration, shortage of social housing, and of course the cost of mortgages. The result is that RICS expect rents to continue to rise as demand outstrips supply. Now again, how does housing compare to the alternatives? Between 2015 and 2022, returns from the stock market and the housing market were fairly equal. Equities, though, were much more volatile. However, this was a period of exceptional house price growth. Credit Suisse Investment, they looked at property markets and equities from the past 100 years or so, and they found that over a 118-year period, equities have significantly outperformed bonds and property. They found that globally, the housing sector returned a quality-adjusted real capital gain of approximately minus 2.1% per year. By contrast, equities gave annualized returns of 5.6% between 1974 and 2002, and very similar 5.3% return between 1900 and 2022. Bonds, by contrast, gave a return of around 3.4%. Now, it is not strictly comparable because equity included reinvesting dividends, but property, they didn't include reinvesting rental incomes. Nevertheless, property over the long term has not always provided spectacular gains that you might expect. Now, when we talk about investing in housing, it can mean very different things. We have the professional investor looking to diversify their portfolio, and they're in property for the long term. Then there's a buy-to-let investor hoping that prices will rise and interest rates stay low. But then there is a person who buys a house to live in it. If you live in a house, there's no capital gains tax, and also, very significantly, you avoid paying the thousands of pounds a month in rent. Average rental values in the UK have now risen to around £1,200 a month, and in London up to £2,500. So if you're in your 20s and you expect to live for another 60 years, that is around £14,000 a year, or £864,000 in rent over the course of your life. Live in London and you will be paying £1 million in rent within 33 years. Now, to escape high interest rates, new buyers are getting longer mortgage terms up to 43 years. Now, this increases the overall cost of buying a house, but the hope still remains that by the time you reach retirement, you will be free of mortgage and renting costs. And this is a very significant investment for retirement. Now, I should say this is definitely not financial advice, but when I bought a house in 2005, I was really stretched financially. I struggled with mortgage payments around 35-40% of my salary, so I stopped my private pension. My logic was that I would concentrate on buying a house and worry about a pension later. 20 years later, now the mortgage is a smaller share of my income, I am trying to overpay the mortgage a bit, catch up from the past. And when I've overpaid a mortgage, I may go back to having a private pension. Now, also, at the moment, we're all concerned about the current difficulties of the housing market, and it's definitely going to be a difficult year or two or even 3. But in terms of investment, we need to look at the long term. And a good question to ask is, where will house prices be in 10, 20 years' time? And if you ask me, I would say a lot higher, probably. Now, the Bank of England's own inflation forecasts suggest deflation in 2024. If we did get deflation and recession next year, we could very feasibly return to lower interest rates, which would once again spark the whole price rise that we've seen recently. But that's quite speculative. But the Resolution Foundation report into the housing market suggests prices could fall 25% with interest rates of 6%. But if interest rates were to fall back to 1%, we could see once again very big price rises. The housing market is cyclical, and although the next few years will be very tough, given the rise in the population, given the rise in households and the relatively limited growth in supply, we are unlikely to see a Japanese-style decade-long fall in asset prices. In 10 years' time, I would still expect house prices to be significantly higher than now. And this is why big investors are not going to leave the market. They can afford to ride out the storm and benefit from the rise in rents. So is housing a good investment? Well, I think if you buy to live in it, then generally the answer is yes. Even though prices might fall in the next 12, 18 months, if you're a cash investor in it for very long term, I think it generally can be a good part of your portfolio. If you are thinking of taking out a buy-to-let mortgage, hoping for capital gains and easy profit, then at the moment it definitely isn't a good investment. So it does depend why you are buying. Now, if you like this video, you'll find this one also useful. It goes into more detail on whether it's a good time to buy a house in 2023. Thanks a lot for watching.